Well, this is one of the things I do here at K-State. I do the cash rental estimates, and that's actually one of the things I get the most questions and phone calls of any of the publications I do. I always get the phone calls from the tenants explaining, well, why isn't the cash rents higher? Then I always get the calls from the landlords saying, well, I know they're the ones who, the tenants want to have lower rates and the landlords want to have higher ones. So anyway, I figure as long as I'm getting an equal mix of calls from landlords and tenants, I'm kind of doing the right thing. The first couple of years I've been doing this, I tended to have rates quite a bit higher than what the was showing in their survey. So I got a lot of questions about that. This year, I think hopefully I won't get quite as many phone calls because actually my rates are actually pretty close in agreement with what the NAS survey that just came out was going to be. So anyway, so I do this. I do a net farm income forecast for the state a couple of times during the year, and also do the budgets here. So any of those questions, feel free to call me about that. I noticed there wasn't anything on the agenda specifically about net farm income projections, so I'll include a little bit about that in my presentation because there is quite a bit of correlation between what the outlook is for net farm income for the state and what we kind of project for the cash rental ratio in the year. So I'm going to talk first about the income situation, and unfortunately it's not going to look very good as I get through that here. I'm going to talk about several aspects of the farm balance sheet first, the debt levels, the interest rate, net farm income, and what my outlook is for farm expenses. The farm expenses may be the only good bright spot in the whole thing I'm going to talk about today. So if you look at the debt to asset ratio, you guys as lenders, that's probably one of the very first things you're looking at when someone comes in for a loan is, well, what's their stake and my stake in the farm business? I always tell my farm management class is that you shouldn't treat your lender as your adversary, because really when you look at the debt to asset ratio, the debt to asset ratio really represents you guys as a lender, your stake in that person's farm business, right? That's how much of those farm assets that the lender actually controls. So I tell my students that you should look at your lender really as your partner in the business. Now, you guys as lenders, you don't want to be the majority owner of that farm business, right? You guys are lending money to lend money as opposed to actually running the farm. So you want to maintain a smaller stake. And the way you find that is by looking at this debt to asset ratio. And if we just look at this, this is for the three parts of the state. I always divide our data for the KFMA program into three areas and look at it kind of that direction. You can see during the entire 50 plus years of our KFMA program where we actually have computerized records that this debt to asset ratio is the lowest it's ever been. Now the KFMA program actually goes back further than this, but we didn't really get records that were able to be computerized and used until about the early 70s right here. This is the best we've ever been, which would think, okay, farms are in really good shape. But just remember what this ratio is really calculating. It's calculating the debt level over the entire asset amounts here. So you can easily raise debt on your farm and still have the debt to asset ratio go down if your asset values go up faster than what your debt level is. And that's kind of what we're looking at right here. So farmers have certainly been taking on more debt, and I will show you that here in a few slides forthcoming, but that has been outweighed by the fact that we've seen a whole bunch of appreciation in land values, and it has really brought down this ratio, so it's in really good shape. Because the way this ratio is calculated, and then we have appreciation in land values affecting this ratio doesn't really start to look bad until we actually have a major crisis in the farm economy. And then we saw that here back in the 1980 farm crisis, that this ratio really didn't start to look very bad here until we were at a point where land values had already crashed and there were a lot of farmers in trouble. That's really when it started to show up. And if we use this as a way to predict, it's just really we're not going to predict problems here. So this ratio is going to look really good until suddenly it's not going to look good. And that's going to happen if land values would ever crash like a third to a half, like it did during the 1980 farm crisis. Certainly, I don't really expect that to happen, but I'm sure they wasn't expecting that to happen back here then at that point either. Well, just looking at the farm balance sheets, this graph really represents the farm balance sheets across the parts of the state. This very top line represents the sum of the equity and the debt in the farm business. And what you're seeing here is that our total assets have certainly been growing, but they've been growing by the fact that our equity in the farm business has increased, really thanks to the amount of appreciation in land values. If you look at the very bottom line, this blue, dark blue area, that represents the amount of debt that farms in our state have. And you can see pretty much across all regions of the state, except for maybe here the last couple of years in western Kansas, we have been adding farm debt to our farm businesses and really at a pretty good rate. It's just been outweighed by the fact that our appreciation of land values have kind of outweighed that. That makes the net to asset ratio look really, really good. Here's where I get a little concerned, because now suddenly you take that debt and you take away the appreciation in those land values. Here's what the farm debt has looked at when I allocate that across crop acres. So this would include not only the owned acres that a farmer owns, but I'm also allocating that across the rented acres as well. So basically that farm base that the farmer farms, and you divide that into the amount of debt that the farm has there. Look what has been happening to our debt levels on our farms. You can see that the debt level per acre actually came down as the farm crisis was winding down back in the 80s. But ever since then, almost every single year, this number has been increasing to the point now where we are really at record levels, except for maybe out in western Kansas. I noticed last night when I was looking at my data here, I was wondering, well, how come I don't have the last couple of years for this area right here? It turns out I made a mistake in my scaling of my graph. If I would add another $50 on here, you would actually see the top end of this red line. So actually in eastern Kansas now, the amount of debt per acre is $425 here. That's certainly the highest it's ever been. And that kind of concerns me a little bit. So certainly we are at a point now in agriculture where it's more expensive to farm now than what it ever has been, right? I just heard a farmer talking on YouTube the other day. He was explaining to the audience he was talking to that, every time I go out and buy a new tractor, it's like the typical consumer going out and buying a new house, right? That's how much you're spending to buy a new tractor, except I got to pay for that tractor in 5 years, whereas you got 20, 30-year loan to pay for that house. He says you're doing that every so often, every couple of years to buy a new piece of farm equipment here. So certainly a lot more expensive game, I won't call it a game, but it's certainly a more expensive business to play with as farmers to actually grow a crop, because it does take so much in the way of assets to actually produce a crop. So it's not unusual to see the fact that we do see more debt, and also the amount of value of farm production or gross revenue that farm's generating is also bigger too here. So in some ways, that kind of covers for the fact that we have more debt, but it's still a concern here. The reason why this amount of debt really hasn't been a problem is until just recently, the interest rates have been fairly low, especially if you go back and compare interest rates to what they were back in the 1980s here. So it's kind of almost like the U.S. economy is, we have record amount of debt right now, thanks to running up almost yearly record deficits. The fact that we have low interest rates means that interest cost really hasn't become burdensome for the U.S. economy. The farm situation is almost the same situation. We have quite a bit of debt out there, but the fact that interest rates have been fairly low means our interest expense ratio really hasn't been a problem up until this point in time. And again, here's this interest expense ratio, which really just takes your amount of interest divided by your value of farm production, or divided by the value of gross revenue. Value of farm production and gross revenue are very similar concepts. Value of farm production is just revenue produced on the farm, whereas gross revenue would be all the dollars the farm brings in. This tends to be a big red flag. Back in the 80s, this got above 10% for practically all the farm groups. Even the median farm, the farm in the middle, had that interest expense ratio above 10%. That's basically saying for every dollar you bring in, if your interest expense ratio is 10%, that means 10 cents of that dollar you're bringing it goes in just to pay for the interest cost. And we learned back in the 1980s that when that ratio got above 10%, that was just too big a hurdle for farmers to overcome. They had to pay 10 cents off the top of every dollar just to cover the interest expense. That hardly left any money to cover the other expenses, to cover family living and everything like that. So that was a big red flag. That's why when the Farm Financial Standards Committee was put together back in the 1980s, they kind of separated interest on the income statement as a separate line item, just to make that more noticeable to people as they go back and look at those income statements. Well, since then, interest rates have dropped and it hasn't been a big deal. But if we'd ever get to a point in time where interest rates would get up to maybe the 8 to 10% range, then you're going to see the interest expense be something really something to focus on here. But you can see since then, thanks to lower interest rates, this ratio is really in pretty good shape. Even the farms in the kind of the worst 25% of farms, as far as this ratio is concerned, all those farms are still below a 10% rate. So it hasn't been a problem over the last maybe decade or two, thanks to low interest rates. But again, if we do see a period of high inflation and we have to raise interest rates, this could be something to keep an eye on again. So the one thing I do when I'm looking at the interest expense ratio is actually to calculate the rate that we actually pay on our farm debt. I'm able to do that with our KFMA farm data because I can just take our total interest cost every year, divide it by the total amount of debt, and I get an interest rate. And you can see what it is right now. Well, really the average farm interest rate on our farm is about, I'd say about 4.5% right now. So that's pretty good. This includes all the debt though. So this would include not only operating loans, but it would include any kind of machinery loans, as well as any kind of land loans in there as well here. So right now it's looking fairly well. The thing that kind of concerns me a little bit is if you go back and actually calculate the correlation with what the prime rate, you can see there's a very high correlation between the prime rate here in red and then our average interest rate that our KFMA farms are paying here. So as you might imagine, because the interest that I'm calculating from our KFMA farms is kind of an average overall debt, it's going to be more sticky and not jump around quite as much as the prime rate, which is more of a short-term rate. But you can see there is a high correlation here. We're at a point right now where the prime rate is quite a bit higher than what the average farm rate interest rate is on our KFMA farms. At some point in time, these are going to have to start matching at some point, even with the fact that we're going to see a 50% basis point drop. That's still a long way from where we currently are. So even though interest rates are probably going to come down a little bit this next year, I expect that the amount of interest we're going to see KFMA farms pay go up, because this gap like this is not a long-term situation. This is going to start to go back up again. So I would really expect to see the interest paid on our farms to actually go up over the next couple of years, so they kind of get back in balance again. The other thing I like to do is, well, let's look at the interest cost on a per acre basis. So basically, again, I just take our interest cost divided by the total number of acres, and you can see this has been pretty steady really since the end of the farm price here. It tends to go up and down a little bit, but it has been fairly steady. Again, this is more of a factor that the fact that lower interest rates have been outweighing the fact that we have taken on more debt for our farms. It's also the fact that we probably have more crop acres too to help mitigate that. But it's been fairly steady. But again, this could easily go back up if we see a period of higher interest rates coming up, possibly. Well, what about net farm income? Because as you might imagine, a lot more net farm income that a farm brings in basically gives them more ability to go out and rent more ground and pay higher rental rates. That's tend to what happened. Well, what's going to happen with net farm income? Unfortunately, it's really not necessarily a good situation going forward. You can see what has typically happened. For the longest time, we had net farm income numbers that were probably anywhere from around $50,000 to about $100,000. That kind of changed here in about 2005 to 2010, this neighborhood. Suddenly, farming, which was really a fairly steady net farm income from year to year in a lot of years, suddenly we had some really good years, right? But those were offset by then some periods of kind of poor years again. And we see this wild swing going from high net farm income to low net farm income and vice versa here. That makes it pretty hard to predict what the cash rental rate should be, just because we don't know, well, is this the new normal, or are we going to go back to a period like that? We're in a case now where, okay, net farm income has dropped. Is this just going to be a short-term situation, or maybe 3 years from now we're talking about a case maybe where net farm income is back over here again? So certainly I think the volatility in farming has gotten a lot worse than what it has been. Not only is it more expensive, but there's a lot more volatility in the net farm income as well here. Especially it shows up even more when you look at the situation of net farm income per crop acre. And this tends to be really volatile, especially in certain areas of the state. I think probably in the eastern part of the state, we see more volatility there, as maybe as well as the other part of the state, but a lot of changes back and forth every single year. Here's my forecast for net farm income. If you guys have been looking at Ag Manager and what I put out for this, usually about 3 or 4 times a year, I'll do an update to my net farm income forecast. So here was what I was thinking was going to happen at Memorial Day. So, 2022 was a pretty good year. We had the average net farm income was above $200,000. It really dropped off in 2023, about a 50% drop to about $90,000, and these are real numbers. We have the data to support these numbers right here. These are projections, these last 2 numbers. But one of the reasons why net farm income dropped off in 2023 was the fact that we had this big drop in our inventory values. We ended the year 2022 with fairly high levels of grain that had a pretty good value on that grain. Well, as that grain was sold off, it was sold off for a much lower value than what we had at the end of the inventory the previous year here. So that drop And inventory values really affected the revenue from the grain side. That's one of the reasons why you saw this drop off like this. So my initial forecast was back in Memorial Day, well, we're going to bounce back a little bit from that because we're not going to have that big drop off in inventory values. I was thinking, we'd be up to maybe like the $120,000 range, which was certainly lower when you compare it to maybe the last dozen years of net farm income. But if you go back farther, this number is really kind of within the historical ranges of what net farm income has been. Well, over the 2-month time with the dropping grain prices, right now I'm predicting net farm income really to probably be below $50,000, which is certainly not a good thing to hear. That's could certainly change again before the end of the year is over. But that's not a good situation. I expect maybe a little bit of bounce back in 2025. But it's still going to be pretty low. It's probably not going to be much above or maybe not even up to what we had in 2023 here. So the next 2 years look pretty challenging to be a farmer out there just because we do see some low grain prices with maybe some drop off in our expenses, but not enough to make up for those lower revenue sources. I guess the only bright spot in this whole picture is that we are going to look at maybe some pretty good yields, at least maybe for soybeans and say corn yield is probably kind of normal, but certainly a better yield situation than what it was the last year or so. If we look at the U.S. though, here's one of the reasons why grain prices are what they are, because this is the condition of the U.S. corn. I've been doing weekly updates for the condition of the corn. And I use that as a model for me to model what the yields are. So far, my yield forecast for corn and soybeans really follows pretty closely with what the USDA has. I'm able to project corn yields over on a weekly basis because I use the crop condition report that comes out every week as a way to forecast what the state yields are. Then I combine those into a national model here. But here's our current U.S. corn situation. It's really about as good as it's ever been. I'm looking at about 65% of the U.S. corn to be in the good and excellent category, about 23% in the fair, and then only 12% in the poor and very poor category. And I do the same thing over on the Kansas side. So what do you guys notice compared to the U.S. corn condition versus the Kansas corn condition? You guys see any differences there? See a lot more volatility over here for Kansas versus U.S., right? If you look at the U.S. numbers, there's only 1 year out of the last 20 that really sticks out to me. That's 2012. And I remember that talking to my cousin who farmed my family farm back in Illinois. They had a very bad year that year too here. That's really the only bad year out of the last 20 for the U.S. Compare that to Kansas. Well, 2012 was a bad year in Kansas too, but this is also a bad year. Here's a bad year too. So a lot more bad years in Kansas compared to the rest of the U.S. You know, if you're from Illinois, which I am, you know what your biggest problem in Illinois is when it comes to the weather? It's how to get rain off your field. It's how to, so fields that have tiling have a premium price compared to the fields that don't have tiling, right? Would you love to live in a state where wouldn't Kansas be great if your biggest issue was how to get water off the field? That would totally change the dynamics of how you grow your crop here. So that's their biggest problem, is how to get water off my field. You know, that's Kansas is 180 degrees, the other situation. So because of that, because we're trying to get water off the field and also the big grain producing states, we tend to have a lot of years where we have very good corn production. The same thing for soybeans. Not quite the case here in Kansas. Here's my forecast then. This is the most recent one I did. In fact, the last one I'm going to do for this year is the 9/15 one. You can see what my projection for yields are and what the correlation are. So this model works pretty good for corn. I get pretty high correlations. So I'm from Illinois, and this kind of stuck out to me is Illinois is predicting record corn yields, and they're looking at an average state yield about 220 bushels per acre. Remember, Illinois doesn't have a bit of irrigation in the state, except for maybe just a pocket here and there, but almost all dry land corn production, 220 bushel corn yield for the state. Now, I grew up in very southern Illinois, south of Interstate 64. I remember being in high school, my dad was talking about we were going to have like 140 bushel corn yield that year. And that was a great yield for him. That was going to be a record yield for us. Talking to my cousin just the last couple of years, they've been getting over 200 bushel per acre on my family farm back in Illinois. So in that time, that 30-year time frame since I left Illinois, you know, they've raised the corn yield by over 60 bushels per acre. That's just amazing to me that they can get that much corn yield. So overall, we are expecting a record corn yield, probably about 183 bushels per acre. That's almost going to be record production, but acres are down slightly here. So we're probably looking at the second biggest U.S. corn production year in history, was certainly a record year here. That's one of the reasons why you're seeing lower corn prices. Here was my prediction on a week-by-week basis. Basically, since the end of June, I've been slowly ramping up my U.S. Yield prediction, except maybe leveling off a little bit here. But it's been a really good year across the U.S. in the most part, except for a few states. You'll notice here, North Carolina really sticks out because they're having a terrible year this year. Not only are they getting flooded right now, but they were really dry during the summer here. So their yield is really off here. So they're really getting the double whammy this year. Same thing on the soybeans. Again, really good U.S. Soybean production is probably one of the best crops they've ever had. Our Kansas crop certainly looks pretty good as well, except for maybe a little bit of dryness here at the end, but still a pretty good soybean yield. You can see what my soybean yields are in Kansas. I'm predicting about 38 bushels per acre. That is a big increase over what it was the previous year, right? About almost 50% increase there. But overall, we're looking at about 53 bushel per acre soybean yield across the U.S. There's more acres of soybeans, so we're easily going to have a record soybean production across the U.S. And you can see my model for soybeans, basically for almost the entire year here, I was predicting a little bit increase every single week for the soybean yields. The one bright side of the whole picture is that I think farmers are going to catch a break on the expense side this year. It's not going to be quite as bad as what it was the last year or two. You can see this is relative to the prices as of January 1st. 2023, so we're about 18 months removed from when my reference point is here. So here's my reference point, the 1st of January 2023. What has happened to prices? You can see we've seen a big drop in fertilizer prices, especially during the first 7 months of July of 2023, and then they started rising a little bit. They're up to about this point here. But certainly big drops here, drops in the fuel price. Drop in the herbicide prices. But again, this is relative to the 1st of January 2023. If you go back previous to this, herbicide prices were about 50% increase the previous year here. So even though they've taken a kind of a drop down from a historical perspective, herbicides are really still pretty high here. You can make the same argument about fertilizer. We've kind of maybe reached a new level here, but this is certainly a level higher than what it was about 4 or 5 years ago too here. The other bright spot is practically all of our expenses over the last 18 months have been lower than our CPI index, which is this dotted line right here. So that's the one bright spot, is that farm expenses haven't increased as much as the inflation over the last 18 months or so. Something to keep an eye on, and this kind of worries me a little bit here, is there's a weird thing going on right now between the gasoline and the diesel price thing. Okay, so if you guys drive around town across the state, at least I did on the way back, I could get gas probably for about $2.80, $2.85 on the way back from Garden City yesterday, somewhere in that neighborhood, right? Diesel price tends to be at a premium, but that premium value has changed considerably over the last year here. So now we're looking at a case where this is a premium between diesel and gas for the last 12 months. We've been anywhere from 10-cent premium up to almost $1 premium. And it's been this light way for 2 years in a row now, where we see this big switch in our premium amount. Before this, if you go back 3 years ago, the premium tended to be more constant, probably in the 40 or 50 cent range. This represents both a challenge and probably an opportunity for farmers, because if you can find the time of the year where diesel prices are at the lowest relative to the gas price, you can really save yourself a lot of money. This premium tends to be the highest, though, at least the last couple of years, right at the fall harvest season. So right now it's probably tends to be the highest price premium we see. Maybe it increased a little bit during the rest of the fall and go down during the spring and summer. So if you can make if that pattern holds true going forward, farmers potentially can save some money by timing this and trying to find these points here. Again, if this kind of holds right here, I'm not sure what's causing this price premium to vary like this, but I think it bears an eye watching going forward. Being the political skeptic that I am, I think there's some incentives out there right now to hold down the gas price. I don't want to say that's happening, but just a skeptic of me says, that kind of thing. I wouldn't be a bit surprised if there is some pressure to do that here. So gas price is fairly low. We'll see what happens with the price premium, but farmers, they could pay a lot more than what they might need to, because 80 cents a gallon difference here, you're talking real money at that point in time.
Here's my forecast for highway diesel prices, basically looking at probably about a 350 range for diesel prices. But this gray bar represents kind of the range that this could be in, and it's a fairly large range, anywhere from about 325 up to about 375 here. So anywhere like that would be the range I would expect going forward. Just based on what the oil price is, I don't really expect a big jump up in gas and diesel prices. But as Brian mentioned, there's a lot of wild cards out there in the oil market, right? Not only in the Middle East, but certainly in Russia, to me is the biggest concern. Russia is actually the second world's first or second largest oil exporter behind Saudi Arabia, or just ahead of Saudi Arabia, depending upon or one or two. Lately, the Russian-Ukraine war has kind of taken this turn where Ukraine now is able to strike deeper into Russia. If that continues, and they've already been trying to do this, they've been putting some pressure on the Russian oil market by basically targeting the refineries. If they're successful enough with those kind of strikes, Russia suddenly may not be able to be the world exporter like they always have been for the past decade or so. You guys remember when Ukraine, or when Russia first invaded Ukraine, what happened to oil prices? They got up to about 140 per barrel. Right now, the oil price is probably in the low 70 range here. So the traders have basically taken out all of that risk premium out of the oil market because they think Russia is going to continue to produce oil. When that war first started, there was some risk there that they thought that may not happen. I would argue that risk is still there. We're just not seeing it in the price here. So that's a concern for mine here, that if oil prices would jump up, not only would farmers pay more for diesel fuel, but that's going to greatly affect the fertilizer price, and we could see a big jump up in fertilizer prices too. And talking about fertilizer prices, here's my model for this. This model really, I've been doing this now for about 3 years using these three factors, using the corn price, using the oil price, and also using the inflation index. And that has got me past a point where when fertilizer got up to the triple-digit range, I wasn't really predicting that correctly with just the corn price and the oil price. I had inflation in there. That gives me a much better model. Which basically says that now that with corn prices being fairly low, oil prices being fairly low, and inflation may be coming down, we'll probably maybe at a low point where fertilizer might go. But if we saw something bad would happen with the oil market, or a big increase in inflation, we could easily see fertilizer prices jump up, and maybe jump up pretty quickly. Here's basically my prediction for anhydrous going forward for the next 12 months. I'm looking at probably maybe in the 650 range going forward. But again, this assumes prices of where they are. Again, we see oil prices jump up, then we could be, and inflation jump up, we could be a situation back over here. And you can see how quickly those kind of things could happen here. I have a hard time seeing how really most of the fertilizer prices could go much lower than what we're seeing at this point right here. If anhydrous got below 600, I would kind of be shocked by that, because to me, the fundamentals just aren't there to support that. All right, a little more detail about my net farm income prediction. Here's how it looks like. When you can see more of the little detail in there, I'm showing a little bit of increase in revenue this year, even though grain prices wouldn't suggest that. But again, this is really because the grain revenue here was really depressed by that change in inventory values we saw the previous year. So that's why the revenue numbers look a little better for grain. What I'm really seeing, though, is I'm expecting a lot lower crop insurance payments this year than what we had the previous year. That's where the majority of the drop off in our value farm production has come from. Kind of steady for the most part as far as what the expense side is concerned. And that gives me to a point of probably about $45,000 for net farm income. I'm probably a lot more confident in this prediction than I am in this prediction, because I know what yields are at this point in time for the current year. I already know what the farm program payments are going to be because of the way those are calculated. I have a pretty good idea for what the insurance payouts might be. So I have a fair high degree of confidence in this, not so much in this. Beyond this, I don't even want to try to make an estimation. I can use the futures market and such to give me this, but if I go too much further out, then I even lose that here. So this is about as far in advance as I really want to try to predict net farm income. Looking at different parts of the state, you can see there certainly has been a different effects here. To me, it looks like the eastern part of the state is going to take it worse than what the rest of the state is. I'm actually predicting a negative average net farm income for the east. Better off in the central part of the state, and the west is kind of in between, but you can see they're not looking all that great either. And then again, some bounce back in the following years. But again, it only puts us back where we were back in probably 2023 as far as net farm income. So it's certainly not a good short-term forecast for my net farm income projections. It looks even worse when I look at the margins here. So this is basically a CDF where I rank every farm. Again, I'm using the KFMA farms to predict my net farm income. I'm doing it on a farm by farm basis. So if I rank those in order and look at the distribution, in 2023, we had about a third of our farms, 30% of our farms had negative net farm income, which, that's a little higher than normal, but, I guess as an analysis, I can live with that. What really concerns me is over the next 2 years, we could be close to half of our KFMA farms with negative net farm income. Now, that really concerns me if we're in a situation like that. You guys should be concerned as lenders too, because it's a lot harder for you guys to justify loans if someone comes in and they show they had a negative net farm income the previous year. Going back and looking at my projections for this coming year, I have a first stab at crop budgets out there. If you go to Ag Manager, look under the budgets, I did an August update to the previous year's budget. That should be a pretty good guide for what my 2025 budget is going to look like. I wouldn't expect those to change a whole lot here. Every single crop now is almost always going to be negative for returns above total expenses. When I combine fixed expenses with variable expenses, I think I only have 1 or 2 budget projections where this is even positive. We still have return above variable expenses, but it's not going to probably cover total expenses. So farmers buying machinery this year, I think it's going to be a stretch. I don't think they're going to have money to do it. And Deere's even seen that handwriting on the wall with the fact that they're making layoffs as well here. So I think everyone out there is realizing that farmers aren't going to be buying very much equipment over the coming year. And since I project lower and maybe potentially even negative net farm income in some regions, the fact that that's going to affect our rental market shouldn't come as a great surprise. Renting is very important to farmers. If we look at the farmers who don't rent, which is this red line, that's only about 5 to 10% of our farms out there. So practically every farmer out there is renting some ground, and they rent a high percent of the ground, which is what this blue line is representing. Probably about 80% of the land that a farmer farms is rented farmland. Okay, whether they cash lease it or sure lease it, is some type of rental thing out here. So it's very important to farms. And as you might imagine, the rental rate's a very important concern of theirs. I should point out here, so you guys have my dry land rent publication in your publication list, probably there in the back. Rich, did you put that for Ag Manager? Yeah, it's up there too. I expect I'll have the irrigated one probably up next week. I'm still kind of filling over those numbers a little bit. I want to point out though, this is not a recommendation for what farmers should pay for a per acre property, okay? Look at this only as a negotiating point. Really, what's considered to be a fair lease is whatever a tenant and landlord agree to without someone holding a gun to their head. And as long as they're both happy with it, that's considered to be a fair lease. I'm having my cousin back in Illinois farm my farmland. He had to put up with my dad. My last couple of years of my dad's life. My dad just wanted to be on there in the farm so bad. He had no qualms about calling my cousin like at 6 o'clock in the morning and giving him marching orders for what he should be doing that day on the farm. He put up a lot for my dad, so I'm going to cut my cousin some slack because of that here. So I'm trying to get a little bit more lower market rate than I could, but there was some other mitigating factors behind that here. So those kind of factors come into play. Just don't certainly look at it as a starting point. We actually provide like a 25th percentile and a 75th percentile as a range, saying, okay, this 25% can pay this amount, this 25% can't pay that amount. Somewhere in between is probably where the rental rate will fall. But again, that's just a negotiating starting point. That really shouldn't be the final number that people come to when they come up with the lease. So this is a very important point right here. And we produce these publications because USDA does they provide a publication of rental rates for the county, but theirs is strictly a survey approach. Okay, they don't look at anything all about the productivity. What we're looking at in the KSU estimate is we're looking at productivity for that ground to come up with our estimate. They're just doing a survey approach. Their survey was actually done back probably the winter time, maybe early spring, so there's some delay in that. They probably didn't fully incorporate the drop in grain prices in that. And their survey results include both current rental rates and also land that's been rented for maybe 4 or 5 years here too. So it's a mix of things. It doesn't represent what new land is supposed to represent. Our calculation approach really is really for new land in that here. So there's a lot of differences that go into this. I think we do provide a lot of stuff that NAS doesn't provide. In fact, if you look at the USDA estimate survey for what they're going to rate, you're seeing a big drop from 23 to 24. This just came out several weeks ago, but you're seeing a big drop not only in the non-irrigated, but also, especially on the irrigated side here, where the rental rates have went up over the previous year. I'm actually projecting this year for our estimate, if I had to take an average overall, probably about a 15 to 20% drop in our KSU rental rates for next year. That really puts me kind of on par with what the USDA has in their survey, because I was always above them last couple of years. So here's my comparison. Sorry for the fact I didn't get a proper background in this, but here's my estimate for the different regions, the average, what I'm showing for our rental rates. And here's the last NASS survey that just came out, I guess several weeks ago. You can see I'm pretty close. So a few areas I'm below, a few areas I'm above. But this is the 3 or 4 years I've been doing rental rates now at K-State. This is probably the closest I've been to the NASS number. But again, we're kind of measuring different things here, so keep that in mind here. I was always above because I always thought the NASS numbers were kind of lagging. I'm going down, but again, I think NASS is still kind of playing catch up a little bit. You have this graph both in your handouts and also in the publication. It gives you an idea of what my estimates are for the coming year. I think I've got this to a point now where I'm hoping not too many people are unhappy with any single number, counting number that I have in here. So I do a little bit of smoothing with the NASS numbers. I do a little smoothing with the neighboring counties here, but this is what I'm projecting. You notice our highest interest rates are in the northeast part of the state, which shouldn't come as much as a surprise because you get more rainfall there and maybe a little better soils here and probably a higher percent of corn and soybeans compared to some areas down here. So I'm fairly happy about this. If you guys notice anything you think really sticks out as being wrong, I would certainly appreciate any phone calls or emails and you can discuss that with me. But here's what I'm currently estimating this for this. Here's the NASS numbers. If you notice, you compare these, they're really pretty close. I'm maybe probably a little bit just a touch higher than what they are. But I'm expecting fewer phone calls this year because I am not that much different than what the NASS numbers are showing. But here's where I think I can make a really big difference is on the irrigated side. So here's my projection for irrigated categories. I don't have this number in a publication yet. I'm still going through and tweaking this a little bit. I want to make sure this number is correct because I have to calculate the numbers a little differently. But I'm able to project practically every single county in the state that has irrigated farmland. I'm able to come up with a value for that. You'll notice here, if I compare that with the NASS number, NASS is really getting limited on their survey response for irrigated farmland because we obviously have irrigated land in these other counties. NASS is running into the problem that, they can only release data. They have so many survey results they get back for their land that they're doing, and they don't have enough surveys, they can't release the number here. You're seeing that show up more and more in these NASS surveys. So obviously they may have a little bit of data here, but they can't release it here. So I'm able to fill in a lot of the gaps that NASS can't provide. So I think this is a big thing that I provide that we can't get anyplace else. This is a spreadsheet. This is my August 1st update to the budget. So you can kind of see what the overall return above variable and total expenses are. You can see we're pretty much going to cover variable expenses. This is out. Let me move to the eastern part of the state here. This is out west Kansas. Right. Here's corn production out in northeast Kansas. You can see and central and southeast. You can see returns above variable expenses. Yeah, I think we're going to be able to cash flow, so that's not going to be an issue. So at least we'll be able to generate enough cash. But if you want to cover all expenses, very, very few budgets are going to show a positive return here. So again, a tough year for farmers coming forward. Probably not very much equipment being bought, and certainly not a good long-term situation. But I think farmers can get through probably this year, maybe next year. Okay, I don't know if you guys are seeing the same thing or thinking the same thing, but that's kind of my expectation at this point. Looking at soybeans, almost the same situation. We're certainly above variable expenses, maybe a little bit of profit here. This would indicate probably to me that maybe soybeans might be a better crop for farmers going forward. Certainly a lot less expensive crop to grow, which would be one good thing as well here. So pay attention to this budget sheet up on the budget on Ag Manager, the April update or August update, because that will be a pretty close estimate for what my official 2025 budget should be. I don't know what you guys had any farmers talking to you about what they may be growing, but I kind of expect a little bit of a shift to soybeans this coming year anyway.
So any questions or comments going forward? Does anybody see anything that really sticks out as being a bad number for my capital numbers? Again, probably a drop in capital rates, but it's still not gonna make things whole as far as lower net farm income.
You can go back to your map. I've got a question.
The irrigated or not,
Yeah, do another one.
dryland?
Yeah, so,
Okay.
so the Dickinson County number is 72. Okay, and then right below that is Marion County at 47. That's a $25 difference.
Yeah, you're right.
Right over county lines, and I would be interested to see the calculations on those.
Okay, that may be well for me to go back and double check.
I try to do a little bit of smoothing with the neighboring counties. Is that a crop reporting district barrier there too? Do you know?
Um,
Do you know where the crop reporting district would break?
no, I don't.
Okay,
But I would say maybe Marion seems a little low.
okay. I'll go back and double check that to see.